Paper trading lies to you in three specific ways. Here's what actually transfers when you go live.
Paper trading is placing simulated trades with virtual money on real market data. The name comes from the old days. Traders literally wrote orders on paper and tallied them against the next day's tape. Today, it lives inside a broker simulator or a charting platform like TradingView. You click buy. The platform writes the trade to a virtual ledger. Your P&L moves with the real market until you close. Mechanically, identical to a live trade. Chart, ticket, position size, stop loss, take profit. What's missing is the part where money actually changes hands. The order never hits an exchange. No counterparty fills you. The price you see is the price you get. That last line is the first lie a simulator tells you. There are three. And the traders who blow up their first live account in the first 10 minutes after switching over, they didn't know what the lies were. So we'll pull them apart. But first, what the simulator does teach you well. Three categories, in order of usefulness. Platform mechanics. Every broker has its own ticket layout, hotkeys, position sizing quirks, default order types. Learning that your stop loss field expects pips and not price costs you 20 minutes on paper. The same mistake on a live $5,000 position costs you real money. Strategy logic. You'll find out if your setups occur often enough to matter, whether your stop placement is realistic, whether you can execute a rule set consistently, not whether it makes money, whether you can run it. Automated system debugging. Route the same logic to a paper account for weeks. Watch how it handles gaps, news spikes, slow days. You'll catch the bug where your entry function fires twice on a fast tick before the bug catches a real position. Three things. Outside those three, paper trading earns its keep less than you think. Which brings us to what the simulator absolutely does not teach: how you behave when real money is on the line. Every working trader has the same story. They were profitable on paper, they switched to live, their hands shook on entry. They widened stops out of fear. They doubled down on losers. They took profit too early because they could finally feel the dollars. Simulator behavior is decision-making without consequence. Live behavior is decision-making with consequence. Two different skills. Now those three lies. Lie 1. Slippage and partial fills. A simulator fills you at the displayed bid or ask. A live broker fills you at whatever the order book actually has at that microsecond. On a calm Euro-US dollar afternoon, the difference is fractions of a pip. On a US payrolls release, 5 to 20 pips for a market order. Stop losses execute several pips beyond your trigger. Multiply across a year of trades and the gap is meaningful. Lie 2. Liquidity. A simulator assumes the size you wanted is available at the price you wanted. On thinly traded futures or small cap stocks, a market order of any size moves the price you actually fill at. The paper account quietly ignores this. Lie 3. Emotion. Loss aversion. The bias where losing $100 hurts more than gaining $100 feels good does not exist on a simulator at any volume. On a live account, it shows up in the first 10 minutes. Most paper to live transitions fail here, not on strategy. The honest reading? Paper P&L overstates what you'd have made live, often by a meaningful margin. Use it to confirm your rules are executable, not to forecast returns. So which simulators are actually worth your time? The differences across them in 2026 are smaller than the marketing copy says. What matters? Is the data real time? Do your order types and position sizes match the live account? And is the platform you're trading on paper the same one you'll use live? A few worth naming. TradingView-paper trading. Free with any account, integrated with charts, connects to many supported brokers for when you go live. Best for charting-driven practice. Spread modeling is simplified. Your live spread will be worse than displayed. Interactive Broker's Trader Workstation Paper. Mirrors the live TWS environment exactly. Virtual portfolio of $1 million. Ideal if you're going live on IB. Thinkorswim by Charles Schwab. Options chains, Greeks, and a full backtester called On Demand. Strong for US equity and options. Live Broker is regulated by the SEC and FINRA with SIPC coverage. MT4 and MT5 demo accounts. Almost every regulated Forex broker offers them. Pepperstone, IC Markets, Oanda, XM, IG. Same spreads, same instruments as live. Best for Forex and CFDs. Tradeovate and NinjaTrader, default for futures, real CME data feed, real order types, virtual cash. The same platforms power the funded account simulators prop firms sell. What does not matter is the size of the virtual balance. A $100,000 paper account teaches you nothing a $1,000 one doesn't. Set your virtual balance to what you'll actually fund the live account with. Otherwise, you're sizing for a portfolio that does not exist. That's the platform side. The harder problem is making the practice actually transfer to live. 6 rules. 1. Trade the same size you'll trade live. A $1,000 paper account risking $10 per trade if that's your live plan. A $100K paper account risking $1,000 teaches you nothing useful. 2. Write a rule set first. Entry trigger, position size, stop, target, no discretionary trades. You're testing executability, not creativity. 3. Journal every trade. Thesis, stop, outcome, lesson. The journal is the deliverable, not the P&L. 4. Pay the spread honestly. Subtract 1 to 2 pips per trade as a slippage tax. Real fills will not sit at the midpoint. 5. Stop after a defined period, 2 to 4 weeks. Beyond that, you're procrastinating. 6. Trade live small for the last week. Smallest position the broker allows. Feel the difference. That data point is what the simulator cannot give you. A realistic 4-week calendar looks like this. Week 1 is platform, 20 to 30 trades of any kind. Ignore the P&L. The goal is every order type, every chart layout, every hotkey. You should be able to enter, modify, and close a position without looking at the keyboard. Week 2 is rules. Define your strategy on a single page. Trade only that strategy, on paper, all week. Screenshot every entry. The goal is to prove you can recognize the setup and execute without discretion. Week 3 is review. Read every journal entry. Identify the trades that broke a rule. Tighten the rule set. Continue paper trading the revised rules. Week 4 is live, very small. Smallest amount you can stomach losing. Smallest position the broker allows. The week's goal is to feel the difference in execution and emotion. P&L is irrelevant. After week 4, the question stops being, should I paper trade more? It becomes, is my strategy producing the results I planned for? So the verdict. Remember that first lie? The price you see is the price you get. That's the simulator's entire world. Real markets don't work that way. Your hands shaking on a live entry don't either. And the position size you'd never actually take with your own money, you'll take it on paper without thinking. Use paper trading to learn the platform, to validate your rules are executable, to debug an automated system. Those 3 things, it does well. Do not use it to forecast live P&L. Do not use it to build emotional resilience. Do not use it to size positions you wouldn't actually take. 2 to 4 weeks of disciplined paper trading, then live small. That's the path most working traders actually took. And the part most beginners get backwards, after a successful paper run, have your intended starting risk. Do not double it. 12 trades on a simulator is a sample size that says almost nothing about your edge. Platform confidence is not trading skill. The simulator's job is to get you ready for the real thing. It is not, and never has been, the same as the real thing.
Use paper trading to learn the platform, not to predict profits. Full breakdown and link in the description.